Hey everyone. Today I'm talking about a little experiment I've done on depth shots to evaluate the effects of the high frequency order book parameter. But first, back to the trading volume on the graph. Last time I was really confused as to why it often differed so much from both the algo quoted asset volume setting and the volume at order figure in the reports. I regret to say that I have not found a solution. Moreover, it got even more confusing. Let me show you. While going about my experiment, I tried noting the graph volume whenever possible. So right after this trade happened, I checked the volume and it was 110K for a 150K algo, while the volume at order showed 172K. Close enough. I also made sure to turn on the Cloud Data Archive to be able to revisit the shots at a later date for aggregate analysis. A few days later, I checked back, and naturally, I did not remember the volume for every single shot I've been seeing. So I've recorded what I've been shown at that point, 541K. This is the very same shot at the very same zoom level. A few more days later, I was re-watching the captured footage to choose what to put into the video, and to my amazement, I noticed this discrepancy. Yet again, I go to the terminal, and what do I see? 83K. 83. Same shot, same zoom level, same pattern and relative scale of the bars on the graph, but the absolute value is vastly different. Even more strangely, a bit later, I opened the same part of the graph at the same time, but on different accounts. And I got two new vastly different values. One was 614K and the other 76. I have no other basis for comparison to gauge what the truth actually was. Make of it what you will, but my personal choice for now is to give up relying on these bars. This seems to throw my previous approach to selecting coins for depth shots, based on the history of volume bars, completely out the window. Now to the experiment proper. Basically, I set up a batch of twin algos at low BTC volatility that are exactly the same, with the only difference being the high frequency order book option being on or off. There have been a total of 102 individual shots, resulting in 186 total trades, and I have scrutinized each and every one of them. First, let's take a quick peek at what the two orders look like next to each other. Much of the time, they followed one another pretty closely to the point of being identical. Other times, they deviated pretty noticeably from each other for prolonged periods of time, with gaps reaching 0.3 or even 0.6% at times. The difference in behavior was especially evident during rapid volatility, as shown in this example. So let's see how much of a difference this makes when it comes to actual trades. I'll explain the results step by step using a rather ugly looking but hopefully adequately functional tree diagram. So starting at the top, we've got our 102 shots. Between high frequency and low frequency algos, the breakdown is this. 87 out of the 102 triggered a trade with high frequency algos, and for low frequency it was 99, or 97.1% of the time. Here and elsewhere, the top number shows the relevant shot count, and the bottom number shows it as a percentage of 102. Next, let's break down these shots into unique and duplicate. What I mean by unique is where one type of algo made a trade while the other did not in the same shot. Duplicate is, of course, where a shot resulted in trades for both types of algos. There were 18 shots with unique trades and 84 shots with duplicate trades. Naturally, first I wanted to see what the unique trades were and why. The low-frequency algo produced 15 unique trades, so let's look at some of them. One of the examples I was lucky enough to catch live as it happened. You can clearly see that one of the orders opens a position while the other one moves away, just barely missing the tip of the shot. Of course, the one that got away was the high-frequency algo. Just before the shot and right after, both orders have stayed pretty much synchronized. But at the point where the order book became more volatile, the high-frequency algo was faster to react. Here are some more examples. The high-frequency algo moves the order away, while the low-frequency algo makes a trade. And same here. And same here. As you may have noticed, the low algo seems to consistently take profits in these situations. Among the 14 unique trades that follow this scenario, only once was the quick reaction of the high algo a good thing. Here I do not have the price lines on the graph, but the low algo obviously took a 0.5% loss, while the high algo escaped unscathed. So in this subset, it seems that high frequency leads to a bunch of lost opportunities due to moving its order away from the shot. On the other side, we have only 3 unique trades for the high-frequency algo. 2 have to do with the fact that the low-frequency algo at the moment of the shot was ever so slightly farther away from the price, and the tip of the shot reached only the location of the high-frequency order. This is not a rule, as it happened only 2% of the time. There are 2 more unique trades, but they have nothing to do with the movement of orders. One was due to a restart delay, and another due to one of the orders being stopped as out of range, while the other one was not. I disregard these in my comparative analysis. Let's now move on to the duplicate trades. First, I wanted to know whether the outcome of these was the same or different. Same means that both were profits or both were losses. There were 80 such shots. I'm further breaking them down based on the price delta values, meaning the difference between the open and the close prices of the trade. I'm using this rather than the P&L to exclude the influence of fees, which are higher for market stop-loss orders, as well as to mitigate the small differences in order sizes. Here I have defined same to mean that the difference in final price delta value between the algo's performances was not more than 0.05%. And we've got 65 of those. It means that in about 64% of cases, the high and the low frequency algos performed exactly the same within a margin of just 5 cents for every 100 USDT. Here are some more examples, but we won't be looking closely at these for obvious reasons. More interesting are the ones that are not exactly the same. So I've had 15 shots where the difference in value was more significant than 0.05%. What could be the reasons? First, I've noticed that in 5 cases, it was simply a matter of take profit or stop loss being better filled, like here. Both positions are opened at exactly the same point, and the result has nothing to do with the frequency parameter we are investigating, and it's just a function of how the exchange fills orders. In fact, we can join these 2 categories and say that 68.6% of the time, the algos performed exactly the same insofar as they had any direct control over what's happening. The remaining subset of different price values is due to one of the algos securing a better open price during a shot. But which algo? Here is where it gets interesting. Out of the 10, the high-frequency algo got a better open price in 6 cases, while the low-frequency algo did the same 4 times. Here are a few examples of the high algo faring better. In this one, it moved away slightly as the shot was happening. Same happened here. It moved away just as the shot was happening. And again here. But in this case, with the historic take profit, a bigger shot means a bigger take as well. Here, it moved to a more favorable position a few seconds before the big shot, thus losing less than the low algo. In cases where the low algo got a better open price, it was mostly about the low algo having a better position before the shot, where neither could react quickly enough to the shot as it was happening. Moving on to even more dramatic examples, where the outcome itself was different, which is 4 shots. All of them were due to one of the algos having a better open price. Sometimes the difference in open price was very dramatic, like here or here. And sometimes a very minor gap in the open price made all the difference between taking a profit or taking a loss. Overall, out of the 4, the high algo was better 3 times and the low algo 1 time. We can join these groups together and say that the high algo had a better opening in 9 cases and the low algo in 5. This basically concludes the diagram. To me, the most interesting points are that, first of all, almost 69% of the time, it made absolutely no difference whether the order book update frequency was low or high. Mind you, the high frequency eats up at least 5 times more of the WebSocket traffic. So you decide whether it's worth it for the same results. Secondly, low frequency got 5 times more unique trades due to the high order running away from the price just in the nick of time. Luckily for me, 13 out of 14 such cases resulted in profits for the low algo and 0 for the high algo. But that outcome is not a given at all. And thirdly, the high algo was almost twice as successful in securing a better open price during a shot. And in a third of those cases, the low algo actually lost money while the high algo took profits. And one final observation. You may have noticed that in my analysis I have overlooked anything to do with the volume columns at the bottom of the graph. And that is for the reasons I've mentioned in the beginning of the video. Instead, I did another piece of analysis based on the data that I can trust, which is the volume at order in the reports. I did some quick math to gauge how close the volume at order was to the QAV setting in the algo. The average of absolute deviations for the combined algos was 10.62%. As expected, the high-frequency algos were more precise, deviating 9.83% on average, while for the low-frequency algos, the number is 11.31%. Now for something even more interesting. If you only take the profitable trades, the average deviation is noticeably smaller all across the board. And if you take only the losses, the deviation shoots up to over 15% for each category. These numbers prove what I guess is intuitively understood. The closer your QAV setting is to reality, the better your chances are at taking a profit. There's probably much more gold to be dug out of this deviation data, but I'll leave it until one of the next times. For now, thank you for staying here with me and listening to what I have to say. I hope this was useful. See you next time.